So Tyler, we're even with some recent volatility, we're still pretty solidly in a bull market for stocks. You go back to the beginning of last year, the S&P 500, all the major indices are up a ton. And if the economy remains strong, that bull market could continue to run for some time. We've got a couple stocks we want to highlight to talk about those bull market opportunities as the calendar turns to June that we think investors might want to consider right now. You ready?
Bull markets always have pockets of opportunities. You just have to go find them. Let's go.
Well, we got two to help people in that journey to find the best stocks they can buy. I'm Jason Hall. This is Investing Unscripted. This video is sponsored by The Motley Fool. We got even more great stock ideas for you than the two we're going to talk about here. If you're looking for more great stock ideas, you should check out our special link. It's fool.com/unscripted. Go to that link, and The Motley Fool is going to give you its 10 best stocks to buy right now. That's a dozen stock opportunities. It's a great way to kickstart your portfolio as we head into the summer. Tyler, how about you kick us off?
You know me. I've been an oil and gas guy for a long time. And so I'm going to kind of stick to the energy sector for quite a while because I think there's a part of the energy sector that doesn't nearly get as much attention. We're seeing oil and gas consolidation, especially with producers. But one part of the industry that has been largely ignored, I think, for quite some time has been the midstream space, which basically is the pipelines, the storage, the gathering and processing of oil, gas, natural gas liquids like propane, things like that. Those particular assets have, I don't want to say left for dead. That seems to be a little extreme, but it's been a more or less ignored part of the market. And in some ways for good reason. It's a very slow growing industry. It kind of grew a lot in the 2010s with the shale boom. And today there's not a lot of opportunities for growth. But because of that, yields are very high and you have a lot of very attractively priced businesses that because they seem like low growth, they're pretty attractive. And I'm going to go with Enterprise Products Partners. I know that was a long intro, but let's go. The ticker is EPD. Enterprise Products Partners is one of the largest infrastructure companies specializing mostly in those natural gas liquids. Like I said, propane, ethane, butane, a lot of things that we turn into petrochemicals. We export a lot of them. I think the United States has become the largest liquid petroleum gas exporter in the world. And I think Enterprise itself is bigger than the second largest country. So it gives you an idea of the kind of scale we're talking about here in terms of Enterprise Products Partners. And what I have appreciated about this company for years, probably more than any of its assets, which stable fee revenue, kind of all the things that you would want from a stable business, is that management itself has done an incredibly good job of being stewards of shareholder capital, really caring what the per share value of what they do is. You have
This
these
is really
assets.
important, Tyler. I'm going to stop you for a second here because if there's any industry that we've seen significant value destruction in for investors over the past 10 or 15 years, it's the energy industry with executives who are chasing empty growth largely because their compensation is tied to just making the business bigger and not necessarily creating per share value. We're lucky with enterprise products because there's some big investors in the company that have a big stake, and that's kind of helped guide the principles that they operate on that has led to less empire building and more focus on creating value for the people that own the business.
Yeah, the founding family, it's the Duncan family. The founder has since passed away, but the family still owns a considerable stake. It's like more than 30%. And so they tend to have a very large say in what happens. I think there's still a couple of them still on the board of directors. And so because of that, this is a family that's really looking for basically like steady dividend growth. They don't want to, and a lot of capital preservation. They're not looking out there to be aggressive with this because they got a huge pile of money. They just want it to grow a little bit. And hey, if I can go along the ride with let's grow a little bit and pay a good yield, that's pretty impressive. And that's how management gears this business. They keep much lower debt levels compared to a lot of the companies in this industry. I think it's like their debt to EBITDA is somewhere in like the 3.2 range, which is considerably lower than if you look at its peers like Kinder Morgan or Enbridge or anyone like that. And when we talk about the actual opportunity, like I said, it's a slow growing business, so that doesn't sound attractive. But let's combine two things here. Let's combine its current yield and its actual like dividend growth. It's kind of a very crude way of valuing a business or on total returns. I think it's the Gordon growth model that they use. That's the basis for this type of valuation. So you have a company that right now has a forward yield of 7.5% and grows its dividend annually at about a 5.1% rate. So that right there is a 12.6, 12.7, growth yield plus dividend growth. So if you actually think about it in that way, 12.7, despite what I would say over the past couple of years has been incredible returns for the S&P 500, 12.6 is generally above the annualized returns of the S&P 500 over the very long term. And for a business like this, enterprise products, slow grower, it's energy infrastructure, it's not going anywhere for probably 20, 30 years. If you want to make a 20, 30-year opportunistic investment, something that already seems to model out ever so slightly above the long-term returns of the S&P 500, that's pretty good to me. I'm not out there getting 30, 40% growth out of this thing, and I don't think anybody's going to be bragging about owning it 2 or 3 years from now. But 20 or 30 with reinvested dividends, yeah, you might be bragging a little bit.
Yeah, a couple things I want to highlight about that too. It's the stock that I'm going to talk about. We're going to go in a very different direction for somebody that might be looking for that more dynamic, outsized return opportunity. That's also going to come with the risk of volatility. The company like Enterprise Products, which I also own some of, is a great ballast investment because it's a steady eddy. That dividend, like you said, the yield is rock solid. I don't think they've ever cut the payout, and they don't grow at 5% every year. Over the past decade, there's some years that they grew at 1 or 2%, but over the past 3 years, it's grown about 15%, right? There's a tremendous amount to like there, and I think it's a great one to lead this conversation off. So I'm going to go in a different direction, and we're going to talk about Upstart. So the reason I want to highlight Upstart to give folks watching the video something that's a little more of like the dynamic growth opportunity. Let's focus on what Upstart's business is. So they're a platform to help lenders find opportunities to lend in what they say is a better risk determination model than FICO, the FICO credit score. The company's data indicates that there are millions of people that have been kind of left out of the credit economy that are perfectly low risk borrower candidates. And they've found using AI, they've built a model to be able to identify safer borrowers more effectively. So as a lender, you can find safer borrowers, or you can grow faster depending on what your risk threshold is. So right now, it's basically this light blue box. This is their current total addressable market, about $150 billion. Over the past year and a half, they've expanded more into auto. So they're starting to move into that. You combine those together and you're looking at a $850 billion market. They're starting to test home equity lines of credit. You put that together and you're talking about a multi-trillion-dollar market opportunity that they're participating in. Here's the problem. The problem is that interest rates, having skyrocketed, has kind of upended the business. So this chart right here shows quarterly net income. And you can see back in 2021, interest rates were very, very low. The economy was healthy. Business was booming. Every quarter, they continued to see their incomes grow. Now, what's happened here, I've overlaid to this chart the overnight rate, the federal funds rate. When you hear on the news, somebody says interest rates, this is what they're talking about. You see their profits plummeted and fell into losses exactly when interest rates started to go up. Now, why is that? Because Upstart doesn't control the top of the funnel. They have a platform for lenders to use to identify creditworthy candidates. It's still up to the lenders to pull the trigger. Upstart does a small amount of lending they do for testing of products that they keep on their own balance sheet, but by and large, they have lending partners that are banks, credit unions, private lenders that actually own the loans. They either originate the loans through the platform or buy the loans from Upstart. And they've all pulled back, Tyler.
Yeah, and to be clear, it's not like credit unions or anyone has stopped lending because they haven't found good borrowers. As you were mentioning, home equity lines of credit. The actual amount that is being taken out on home equity lines of credit these days is at multi-decade lows.
Yeah, because interest rates have moved up substantially. Now, in fairness, a lot of the personal loans, the unsecured debt, a lot of that is a mix of both less appetite from borrowers, but also less appetite from lenders as well. It's a little bit of both. It has. They've also reduced how much they're willing to take right now because of concerns about the economy, because these are the kinds of loans that are the first thing people start paying late or stop paying entirely when they have to make those choices. There's not an asset to repossess. Eventually, it can go to garnished wages and that kind of stuff. But it's the easiest things for people faced with hard decisions to say, okay, I'm gonna skip that payment this month. So put it all together, and it's a scenario that's weighed substantially on Upstart. Now, again, thinking about the idea of a sustained bull market, a big part of that would be a healthy economy. Potentially, the Fed starting to bring interest rates down a little bit, small decreases, which could increase appetite from both borrowers and from lenders for the kinds of loans that Upstart focuses on. That would be good for its business. And we've seen in the past, when times are good, this business model can be incredibly profitable. And I think that means right now there's an opportunity for investors who are willing to think kind of countercyclical, to lean into some risk and think about the bigger picture in the longer term, that Upstart could be a huge winner once we do see a return back to a little bit more normalized lending activity. Because like you said, right now, these things are at like record low levels of activity. So when things normalize, I think Upstart's really, really well positioned. But unlike enterprise products, this is a stock that's going to be incredibly volatile. The business is losing money, and there's no dividend to make it easier to be patient while the story plays out. So some things to think about. But again, I still think there's a lot to like about Upstart's business over the long term with the risks that we talked about.